Hey folks, hope you all are doing well. I'm Karan Bandal from Econosite, your weekly wrap on economic news from India and around the world. So let's get started. Manufacturing orders for China collapse. According to CNBC supply chain heat map data, US manufacturing orders in China are down 40%. As a result, Worldwide Logistics tells CNBC that it is expecting Chinese factories to shut down 2 weeks earlier than usual for the Chinese Lunar New Year. So, manufacturers are extending the shutdown in light of this fall in demand. This drop is also observed in shipping container traffic between China and the US. According to supply chain research firm Project 44, monthly vessel TEU volume capacity from China to the US saw a steep fall of 21% since August 2022. It is still above the low of summer of 2019, but you can see it has been falling sharply. By the way, TEU stands for 20-foot equivalent unit. It is a unit of measurement used to determine cargo capacity for container ships and terminals. So, US manufacturing orders in China are down. US demand for shipping containers from China is also down. This is creating another problem for logistics managers in the US. Because of the low demand for shipping containers, carriers are announcing more blank sailings. That is, they are suspending scheduled shipping containers. They are waiting for more demand to come through so as to consolidate the load, fill containers to the optimum level, and then start sailing. As a result, US logistics managers are now bracing for delays in the delivery of goods from China early next year. Add to that the impact of rise in COVID lockdowns in China. Manufacturing operations continue to get affected, further delaying cargo outputs. Look at this supply chain heat map. At every export point in China, there is a congestion for vessels and trucks, despite such a precipitous fall in demand. So, supply chain issues just refuse to go away. Another country where this demand slowdown is showing up is Vietnam. Manufacturing orders from the US and the EU have fallen sharply here as well. Since early this year, 12,500 companies were closed per month, a 24.8% increase year on year. In Vietnam, a combination of lack of orders and rise in interest rates from 6.5% to 13.2% led many companies to close factories instead of signing new order contracts. And cancelled ocean sailings bound for Vietnam are up 50% in December. We are starting to see indications of a broader global slowdown. On a brighter note though, according to Project 44 report, trade between the EU and the US has risen sharply. Monthly TEU volume capacity coming into US East Coast from European regions is up 20% since March 2022. You can clearly see a sustained upshift. Europe's manufacturers are increasingly exporting to and investing in the US. Germany's exports to the US were almost 50% higher in September year over year. This year, US has imported more goods from Europe than China, a big shift from 2010s. West's strategic shift away from over-dependency on trade with China is the primary factor for this change and is likely to continue in the future. While the EU and the US are trying to deepen their existing symbiotic trade relationship, one former EU member, the UK, seems to be struggling post-Brexit. UK economy risks lost decade of growth. Confederation of Business Industry, that is CBI, came out with a forecast on December 5th stating that the UK economy will shrink 0.4% in 2023. Inflation remains high and companies have put investment on hold. We talked about capex many times in our weekly updates, and here it seems like companies are just not investing in capex. The CBI's forecast does not expect GDP to return to its pre-COVID level until middle of 2024. UK's unemployment rate stands at 3.6% currently, which is excellent because even a 5% unemployment rate is considered as full employment level. So 3.6% is as better as it can get. CBI Director General Tony Danker said that GDP is a simple multiplier of two factors, people and their productivity. CBI expects unemployment to rise from 3.6% to 5% by early 2024, and as we talked about, 5% unemployment is not really bad. That means there is a clear productivity issue with the UK labour force. Thus, Danker concludes that UK needs to act to improve productivity by making work visa system more flexible and provide tax incentives for investments. In other words, tax incentives for private capex. Otherwise, UK risks seeing a lost decade of growth. UK is not the only country that has growth concerns. In fact, the whole world is battling headwinds to growth. One of the key challenges to growth is inflation. Take a look at inflation around the world. Let's start from the West. Inflation in Canada stands at 6.9%, US at 7.7%, Brazil 6.5%, Argentina 88%. Look at Middle East and Africa. Nigeria 21.1%, Senegal 13%, Egypt 16.2%, Iran 52.2%, and Turkey 88.5%. Let's go to Europe. UK 11.1%, Poland 17.9%, France 6.2%, doing a little better. Now look at Asian region. Pakistan 26.6%, Sri Lanka 66%, India 6.8%, China 2.1%, and Japan 3.7%. This is just a random sampling from all over the world, but you get the point. Inflation is a problem everywhere. China and Japan are the only exceptions. Let's come to India. Some Indian companies are seeing global slowdown reflect in their numbers. Bajaj Auto's exports decline. Bajaj Auto operates in 70 countries, exports bikes to Africa, Middle East, Latin America, ASEAN countries, and so on. This company has had a bumpy ride in Q2. Exports have suffered a sequential degrowth for fourth month on the trot. In November, Bajaj Auto clocked 28% decline in its exports. Anand Tandon, an independent market analyst, identifies two factors for such a poor performance: decline in sales across Africa and a strong dollar. Both point to an economic pain outside the United States. Company management expects normalcy in exports to be restored in a couple of quarters, but it all depends on how long the global slowdown drags on next year or year after that. On the domestic front, conditions seem better. India services PMI gains momentum. Services sector make up a big chunk of the Indian economy. The S&P Global India Services PMI grew to 56.4 in November. It was 55.1 in October. A quick recap on PMI. PMI above 50 means expansion in business activity, below 50 is contraction, and 50 means no change. So here the expansion in services business activity continues. Orders placed with services providers grew for the 16th consecutive month. This solid PMI reading is primarily driven by a strong domestic demand. Along with that, Indian services sector saw a renewed interest from international buyers, which led to increased exports. As we discussed in our last week's update, fall in India's merchandise exports in a slowing world will be cushioned to some extent by India's rising services exports. This increase in business optimism in November led to a boost in job creation as well. To sum it up, we see a set of concerning data regarding the state of the global economy. US is ordering less from China, the factory of the world. Goods shipping volume between the two largest economies in the world has fallen sharply. Inflation remains stubbornly high in all the major economies, holding down their growth. India is the only country that is projected to grow at 6 to 7% for the next 2 years, and even there, manufacturers are feeling the heat of a global slowdown. India will have to rely heavily on domestic demand for the next 2 years and hope in that time the global economy turns the corner. I hope you enjoyed this week's wrap. I'll speak with you again next week. Until then, take care.